How to lower the mortgage rates before you close on the property. Hello everyone and welcome back to another episode at Novarise, your channel for financial education. So today we're going to talk about mortgage rates, what you can do to lower them, and whether it's worth it for you to even think or work on lowering those rates, whether it's for your personal residence or to use that loan for a investment property. So the way today's episode is going to be broken down is that we're going to go over the concept of a point and why you should pay attention to it. And then we're going to go over a case study that was actually presented to me. And I'm going to share with you my thinking process and how I run the numbers that led me to the decision that I made. And hopefully that exercise can help you make the decision, an informed decision that's going to help you pick the rate that makes you feel more comfortable with, whether it's for a loan of 15 years at 30, or whether it's for your personal residence or for an investment property. So without further ado, let's go straight to the tablet. Before we start, let me remind you to subscribe to this channel and hit the notifications button. Okay, so first things first, before we move into the nitty-gritty, I wanted you to get familiar with the concept of a point. So every time you deal with a mortgage broker or lender, they're going to talk in terms of points. So I'm going to offer you this rate for this much points. I'm going to offer you this rate for point, right? So 1 point, each point is the equivalent of 1% of the mortgage or 1% of the loan that you are taking out, right? And please keep in mind, not all lenders work the same way. The scenario that I'm about to share with you was based on my credit profile. So these were, let's say, the rates and the points that were offered to me. But again, every lender works differently, and especially if your credit profile is different than mine. So the numbers that I'm about to share you, just, take it for educational purposes. It doesn't mean that you're going to get the exact same rate. Okay, so let's go ahead and break this down into the following. So we have percentage and we have points, and followed by the cost, the equivalent of those points and costs. And then lastly, we're going to talk about the mortgage payment, right? So when I spoke to the lender for the first time, they offered me 3 rates, right? So the first rate that was offered to me was 3.875% for a 30-year mortgage, and that was going to cost me 1 point. Then the next rate that was offered to me was at 3.99%, and the cost of it was 3/4 of a point, which is the equivalent of 0.75. And then the next rate that was offered to me was 4.5% at no cost whatsoever. So what does that mean? That means that if I chose to not negotiate the rates to a lower rate, I wouldn't have to pay any points, just like you will see here. And I will wind up with a mortgage for the next 30 years for a rate of 4.5. But I figure, hey, they're giving me an option, so let me just take this into consideration. So like I said, back here, 1 point, it's 1% of the mortgage. So in my case, the mortgage that I was applying for was for a total amount of $164,925. So 1% of this will be $1,649.25, and 0.75% of this amount right here would have been $1,236.94. Now, how does it translate to savings in your mortgage, right? So here's the interesting part. So if I would have gone with the option of 3.875% for the cost of 1 point, my mortgage payment on a monthly basis would have been $776. Now, if I would have gone for the second option at 3.99 for 3/4 of a point, my mortgage would have been $786. And then if I would have taken no offer whatsoever, I would have gone with the 4.5 rate, my mortgage would have been $836, right? So now in terms of savings, I wanted to see how much was the difference on a monthly basis, because I want to make sure how much can I possibly get out of it in cash flow. So if I were to go with the second option right here, the savings would have been for $50. Now, if I would have gone for the option at one point, the savings on a monthly basis would have been $60. So my mortgage would have been either $60 cheaper or $50 cheaper, depending on the option, right? And then after that, I started wondering more, okay, well, what's the true difference between these two? Like if I would have paid $1,649 versus the $1,236.94, how much would I be truly saving between the two? And the difference was only $10. Okay, so in my mind, I was like, I don't know. I don't think I'm liking those odds. So I decided to take the calculations down to the next level. Now, if you're enjoying this episode, do not forget to hit the like button right here so you can help this episode rank and help others like you looking for information of this kind. So if I would have gone with the option of paying a full 1 point, right? A full 1 point would have cost me $1,649.25. And as we mentioned over here, the total savings would have been $60. So when I divide these numbers, that means that it would have taken me somewhere between 27.5 months to recuperate the investment that I made here. But if I would have gone with the second option, which was paying a quarter of a point, $1,236.94 for a extra cash flow of $50, then the timeline would look like this. So $1,236.94 divided by 50, that would have taken me a total of 24.7 months to recoup the money. So for me, this option right here made a lot more sense because the difference here, we're talking about almost 3 months. Almost 3 months just to make an extra $10 per month. When you multiply this by the 3 months, what? All of this to make an additional $30? Like to me, it didn't really make any sense. So in my case, in my scenario, the second choice, paying a quarter of a point and lowering my rate down from 4.5 to 3.99 seemed to be the best option for me. However, I wanted to be sure that I was making the right decision. So instead of just leaving things as it is here, I decided to take my calculations down a notch. So I decided to calculate the return, right? So if I were to take $60 a month, right? Option one, multiply by 360 payments because a 30-year mortgage has a total of 360 payments, would have left me with an additional cash flow of $21,600. Now, comparing that to option two, multiplying 50 times 360 would have given me an additional cash flow of $18,000. Why do I say it's additional? Because if I would have taken no discount or wouldn't have bought any point, this would have been my monthly mortgage. But I was trying to see if it was worth it to pay the extra premium so I could lower the mortgage payment down to $776 or $786. So once again, I decided to go with the second option, but I didn't want to stop just right here at the top part. Like I decided to take my calculations down a notch. So instead, what I did was to calculate the return, and I took $1,649.25 and I divided it by this cash flow of $21,600, and that left me a return of 7.6%. I did the same thing with the bottom number, so I took $1,236.94 and I divided by 1,800, and that left me a return of 6.9%. So then when I started comparing these two numbers right here, let's take that 7.6 minus that 6.9%, what I'm getting is only a difference of 0.7%. And that 0.7% was only worth $30 right here, right? This is why when you take percentages, you have to really take the percentage into a context, because a lot of people talk about, oh, I got a 7.6 return or a 6.9 return, but a 6.9 or a 7.6% based on what? Is it based on $1 million or is it based on $100? Because depending on that, you have to see what's the total value, what's the total amount that you're actually letting go or gaining in this case. So for me, paying extra just to get an additional $30 in the span of 3 months was not worth it. Because when you compare the premiums, right? If I were to pay $1,649 and wait 27.5 months versus paying $1,236.94 and just recoup my money in 24.7 months, that would have been a difference of $412.31. So for me, paying $412 more on a premium just to get an additional cash flow of $10 per month, which I would have needed to wait an additional 3 months to recoup the money, was not worth it. And that is how, based on these calculations, I decided to go with the second option because it allowed me to pocket an extra $50 in cash flow, and it allowed me to lock into this very nice rate at 3.99 for the next 30 years. And this approach here works with any kinds of situation, whether you're looking to buy a rental for cash flow or whether you're looking to buy your primary residence because you plan on living there. Putting an extra $50 into your pocket or generating an additional $50 in cash flow makes a big difference in the long run. Now, speaking of buying properties, whether it's for your primary residence or for an investment property, here's an episode that you should check out that is going to tell you everything you need to compile in your hands before you go to a lender and request for a loan. Check it out right here, and I'll see you in the next episode. Bye-bye.